that has probably added, just that deal by itself, I'd say close to $2 million to my net worth, just because of one deal.
Dude, that was sick. Christian's smart dude. And I mean, like, I didn't know if people were gonna have questions or if they were gonna understand all of it, but like people were like super involved and super hyped. Like that was a good conversation. And it went perfect, like great flow.
Yeah, great flow. You guys, he's great at describing the process and describing like deals in general. And then also his stories, like, I mean, I didn't think he was gonna say 2 million though. I'm like, damn, bro.
Yeah.
2 million.
Raising a lot of money.
Multiple M's on your net worth on one deal, bro. That's where we need to be at, Papo. That's where we need to be at soon.
But think about it. You get one of those MLB players that has like a $250 million contract, and you're like, yo, bro, I just need 2 M's out of that.
Man, this guy's got.
That'll make you forever money. You know, that guy's going to be like, okay, let's talk, you know? What's up, you guys? We just finished Ask Alex number 66. This was an incredible special guest week with Christian Bergman, former MLB baseball player turned investor. And Alex, I got a lot of big takeaways from him. He's a multifamily investor now. What were some of your biggest thoughts on what we talked about?
So big takeaways were the terms that you use, you know, how they're different from single family to multifamily, and the deal structures, and also how to find these multifamily deals. And so there's these nuances that you're going to learn if you watch this webinar. So check it out. A ton of learning on this multifamily game. Let's go. What's up, everybody? So we're gonna get Will on, and today we're talking about multifamily. Are you guys excited or what? I know that usually we don't talk about it, but we're in the middle of our first multifamily, and now we want to talk to our man Christian. I'm here in Hawaii.
What's up, Alex? All right, man. This should be fun today, talking with Christian about multifamily. Good conversation today. I'm fired up for this one. Like you mentioned, you know, we just got into our first multifamily, well, commercial multifamily, you know, and I mean, like, it's exciting. It's something that, you know, we've been looking to do for, you know, half a year now, a little bit close to a year now, and been putting it out there and had the opportunity come around now. So definitely an exciting topic and something we'll dive into today.
Yeah, man. I love Christian. He's been a wealth of knowledge for us. He also hosts a weekly Zoom call about multifamily within the Future Flipper coaching program. So he's been very, very active and influential to us. So I'm super excited to interview him, talk to him about multifamily deals, just lean on his experience so far, because he's developed quite a lot over the last year and a half. And I know he brought on his partner, Jeff, and just good dudes, man. And every time we go to Arizona, we're able to hang out with them typically and learn even more and see them grow. Agreed.
You know, again, I think this will be a fun chat, diving into multifamily with Christian. In the meantime, guys, before we do, you know, kind of bring Christian, our special guest, on for this week, as you guys do trickle in, if you don't mind just using the chat feature down there at the bottom, there's the chat feature, and you guys can go ahead and use that to let us know where it is that you're from. I see some familiar faces in there. I see Roshan, I see Desiree, Ben, you know, a couple other folks, you know, chatting in. So everybody, if you get a chance, go ahead and chat in. Let us just know where you're from and what your Instagram handle is. That way we kind of get an idea of, you know, where you are, and we can continue the conversation outside of our Wednesday meetup. Alex, in the meantime, I know a lot going on for you. We're going to dive into the 18 unit today on the chat, but what else is kind of going on with you, man? What's the update? Where are you at? What's going on?
Yeah, man. So let's see here. Oh, man, there's a lot going on. So I'm back here in Maui. I was in Sedona last week, Arizona. I know I was kind of offline. The resort we were staying at had very little reception, bad Wi-Fi, only Wi-Fi in one of the locations. And although I don't think that was done completely on purpose, it did make us all kind of it made it seem like, hey, what kind of business do you have if you can't leave for a couple of days? And fortunately, you, Nicole, all the Rockstar team members that we have ran with the rock, handled business. Although I was a little bit stressed out, I was also building some really high-level relationships and nurturing high-level relationships that it takes a lot of energy, to be honest with you. When you're there connecting with people, talking about their high-level problems, talking about your high-level problems, really trying to find out and going deep. You can't be over on your phone and kind of all distracted. So you got to be locked in for that type of interaction. And then afterwards, I didn't even have hardly any energy because we were doing these activities. We're doing the masterminding. We're doing all the conversations in between all of that. So, but I did take a couple of takeaways here that I want to share with you guys that I think is important for us to talk about. One thing is this extreme ownership idea. Jocko Willink, which is a Navy SEAL, and his company Echelon Front, we did a leadership training with them, and that came up that you really have to take that ownership of the results and the business that you have and what you're working on, because if you don't, then you're not in control. You're leaving it up to the outside forces. And so that was I read the book, but having like that actual training it's really solidified how important leadership is and taking extreme ownership of the results and what you're.
I was going to say, I've read the book as well, and great book, but really cool to see you and the other guys out there and the other girls on the Maui Mastermind trip out there in Sedona. And like you said, you guys are out there actually putting to practice, how these leadership techniques and qualities play out in a business setting. So I think that was a really cool experience to get to do that in person with not only just the group, but the trainers as well. That's good stuff.
Yeah, and one of the exercises or the missions that we did, they had us go and get some intel from this one person. There was actually a whole obstacle course there, and we went, and our job was really simple: just go over here, get this intel, and come back. But then we made it so complicated because we weren't organized, and it was kind of a reminder of hey, how often does your team doesn't really know what's going on at the bottom? I guess the people that are actually doing the work. And so that means that's a training issue. I remember being a shooter, which is kind of the lowest person on the mission, and I didn't know what we were doing. And then I remember when I was in charge and they gave me a leadership position on one of the missions, I didn't know what was going on. And so it really put in real life perspective, how often does my team doesn't really know what's going on because they don't or is the people that work for me or work with me in leadership, are they communicating effectively with the people down the chain of command? And I don't have that problem with you, but we have other issues within the chain of command. I guess that was another big one. Last one I want to say about that Sedona Mastermind, big takeaway was this detachment habit, or the way they describe it, being detached from the situation or the mission or whatnot. So you have a much higher level view, and then you can make better decisions on what's happening. Some people might call that reflection. Some other people might call that just kind of working on your business, but they call it more detachment, because there's times where, say, for example, you're out there and your gun doesn't work. Well, you can't really shoot, but then you're kind of thinking about what else is happening, and you're seeing the field differently. And so just that constant detachment, so that way you're not so in your business, so into what you're working on, that you don't see all the other things that could be affecting the results of that, and just kind of detaching from that. So that was a big one I want to share with you guys, to develop that habit. Afterwards, I spent a little time in Phoenix just because, our 18 unit acquisition is there. I drove by the building again. I met with a couple of investors that, we have so many great friends there, some within the program, a Future Flipper, some, that we've developed relationships with independently. And then also I worked a lot on the 18 unit acquisition over that weekend or the end of the week, because I didn't get that much done during the week, which I felt really this little bit of anxiety because it's such a big deal. And I know I wasn't able to get in front of the computer as consistently as I wanted to, but then I worked on it over the weekend and immediately as I got back here to Hawaii. So I'm back here in Maui. The house is finished. I mean, it's been a long road. We bought the house in May, and it's basically 10 months that we've owned this property, and now it's finally freaking done. My partner's coming next week. He's going to be here for a whole month, taking this whole top unit with his family. And then we're going to figure out after that month what we really want to do with the property. It'll already be refinanced, it'll already be bird. So we'll probably be doing some form of just kind of short-term rental, or some form of just renting it to our core network, or people that we want to give bonuses to on the team and whatnot. See what else. A lot of things going on, guys. A lot of things. And then so I'm heading to Big Island tonight just because we have a flip over there. That flip will be kind of listing this week. So I got to just do the final punch list with Mike, my project manager. We're flying over real quick, only for a day. And then we're hopping to the other island of Oahu, because we got our first acquisition that's right on the ocean, right on the beach, oceanfront property that we're getting heavy rehab, but a magical project in the most affordable part of Oahu. So we'll be over there for 3 days. We have a meetup. with Indar on Friday, which Indar is a real big Hawaii flipper. So we'll be doing that. And then, yeah, man, a lot going on.
Big week, right? A lot of stuff going on, and I know a lot of traveling for you. But it should be a lot of well-paid travel, because it's going to be going around and, like you said, checking on a couple of our existing properties that we're taking down, and getting to go out there and check in with some of the team members as well, which is certainly important also. So guys, another big thing coming up is we'll probably be doing a meetup here in California. One that's probably been getting asked about for a good little bit of time now here, where we've been doing a lot of business up in the Antelope Valley, and so I think we're going to do a meetup out in the Antelope Valley. It's probably going to be a bus trip out there. We're going to do a little bit of an educational session on it. This is someplace that we've been able to acquire 10 to 15 properties out in the desert over this past year and now into this year. So someplace that we're pretty bullish on, and Alex, someplace that you've been pretty bullish on for quite some time now. And we're going to go ahead and do a trip out there and kind of really dive into the entire portfolio of projects that we've taken out there, right?
Yeah, so that's exciting. We're going to do a meetup. It'll be a bus trip. A bunch of people, 30, 40 people, that whoever wants to come out. It won't be free because we can't afford to throw that sort of event for free, but it'll be, really affordable. Just be able to showcase all the work that we're doing out there. Also probably have one of our partners, project managers, Rockstar, that helps us on all the rehab side, Paul, to help out and jump on board and kind of give you guys an education of kind of what we're working on there. But I started investing in the Antelope Valley about 3 years, or more, about 3 years ago. We did a couple of deals out there. We noticed the purchase prices were better. The houses were newer. It seemed to be a little bit less competition. There seemed to be just kind of going against the grain a little bit. Most people don't want to go that far out. It is technically so LA County. Some of it does turn into Kern County, but we've had a tremendous amount of just projects, and then adding team members and people that fit and want to do real estate investing. But it's a bit far out there. So most people are just living out there, staying out there. They're not coming out to core Los Angeles, core SoCal as much. And so it's a market that we've tapped into. We want to share with the tribe, and then see how we could potentially do more deals together out there. How you guys could learn, because there's flip opportunities out there. There's buy and hold opportunities out there. There's a little bit of everything, and it's a really lower price point than what you're going to find in the core Los Angeles areas that we typically invest in as well.
Good stuff, man. Well, I know, it's definitely going to be exciting getting out there and jumping on with everybody. We've got a couple of exciting projects out there, a couple of, 6-figure deals, right? A couple of bigger projects, a couple mobile home projects, a Burr project. So, a lot of different investment strategies that are going into play out there. So it should be exciting to bring everybody who is available to make it out next weekend out to join us. Again, Alex, I know it's been a busy travel week for you, and more travel coming up, but we're excited to talk today with a pretty exciting special guest as well. So do you want to go ahead and bring Christian in here as a guest?
Yeah, I'm going to bring him in. So this is Christian Bergman, you guys. He's a multifamily investor, rock star, used to be a professional baseball player, pitcher, did go to the major leagues. So, he has that work ethic or that drive to make things happen. And then, like I said, he pushed me. I remember having a conversation, Christian, back a little more than a year ago, when he was kind of starting to get his first couple of deals in multifamily. And I was telling him I wanted to buy a 10 unit in the Antelope Valley. And he's like, man, you got to think bigger than that. And I was like, what? Yeah, okay. And he's like, you got to think 50 doors and up. And so he really pushed me to start thinking, getting a bigger acquisitions for your first deal, especially because we did also have experience. It's not like I'm a brand new investor either. And so thank you, Christian, for pushing me. We're in contract for the 18 unit. I know you're crushing it. How you doing today, man?
Good, man. I'm doing well. Thanks for having me on. Just looking forward to this.
Awesome.
Good stuff, man. Yeah, I'm excited to have you on as well. I know, Alex kind of gave a brief introduction of your background, and we'll kind of dive into a little bit more of what you're doing. But, one thing for everybody here who's tuning in, and, we usually have a good amount of folks that watch this on YouTube afterwards as well. A little bit different of a conversation today, right? As Alex mentioned, we are in contract to purchase an 18 unit multifamily property. And so we wanted to kind of, bring on somebody who's been really influential in our multifamily acquisition strategy and, just the research and time and effort that we put into the process. And so this is a little bit different of a conversation than we normally have about, kind of single family strategies, but nobody better, I think, than to do it with than Christian Bergman. So I'm really excited to have you on, man. Do you mind just kind of giving us a brief background, like, where you kind of got started in investing and where you kind of, got before that even? I know Alex mentioned professional ball. So kind of give us a rundown and where you're at today.
Yeah, so hard to go through my story without mentioning baseball. So that's really what my whole life was leading up, basically until I retired in 2019. But I went to college at UC Irvine in California. Was drafted as a senior after graduating. Was drafted by the Rockies. Played in the minor leagues. Actually played against Ryan Pineda. So kind of see how that story loops around. But I actually played against him in college too. But yeah, so went through the minor leagues. I was a late round draft pick, so I had literally no money. Living season to season, getting paid $7,000 a year to play in the minor leagues and chase my dream. And so finally, in 2014, I finally got called up to the big leagues for the Rockies and made my debut and spent the rest of the season up there. And as I'm sure some people know, difference between major leagues and minor leagues is night and day. So you go from, like I said, making $7,000 a season in the minor leagues to making, about probably $7,000 every 2 or 3 days. So big difference. And, I kind of took a different approach as far as my investments and stuff. And that's just kind of how I was. But I started learning about, stock market, stuff like that. It's kind of where I started. Didn't really like the idea of that, the lack of control, stuff like that. So started looking into real estate investing and just learning the very basics, buy a property, rent it out, you got cash flow left over after the tenant pays all the expenses, obviously. So the next year I bought my first property in Scottsdale, and my plan was to live in it during the off season. And then during the season when I was off playing, rent it out. So that's kind of where it started. And, that worked well the first year. And then I was in the big leagues again the next year. So I had, a good amount of money to play around with. Obviously, most of my time was spent playing and training and stuff like that. So that next season, I bought another rental property strictly as a rental, another condo in Scottsdale, rented that out. And important note, I paid cash for it. So, was still learning, did not have the foundation of like the power of leverage and stuff like that.
Still not using leverage, right?
No, yeah, because I didn't know what I didn't know. And so my thought was like, well, if I'm completely wrong about all this, at least I don't have, a mortgage payment hanging over my head. So that was my reasoning. So obviously it cash flowed because it had no debt on it, but, started to learn the process of managing rental property. The next year I was in the big leagues about half the year. And so basically I was kind of following the process of buying a property every year. And when I did that next year, I bought a house over in Phoenix, moved out of the original one, turned that into a rental, moved into the house. So kind of my goal as I was going through this was to have my primary residence being paid for from the cash flow by the other properties. And so, fast forward a couple of years, I was able to accomplish that. And by no means was this quick, but I hit my goal of like, when I was off playing, the cash flow from my rental properties was paying for my primary residence that I really wasn't using, which was my goal. Because you have to, and that's one thing people don't see in baseball is like, yeah, okay, you might make a lot of money, but if you have a primary residence and then you have a residence, even if you're renting in your city you're playing in, that can get expensive. So that was my goal, got there, and decided to retire in 2019. So played 10 professional seasons. And by that point I had, the 3 rental properties in my primary residence. So then I was looking for ways to, okay, how can I do real estate actively? I like real estate. I always kind of knew that's what I wanted to do. So started looking into wholesaling and flipping. Didn't really understand what wholesaling was, to be honest. So started working for a company here in Phoenix.
And you worked with them for what, like over 5 or 10 years, right? This was like you worked with them forever, right? This was
it was
really,
a
really long relationship.
Long
10 years in the big leagues, 10 years with this wholesaler, right?
People don't know, he's being very sarcastic. I was there, I lasted 6 days because I saw, not that there's anything wrong with wholesaling, but like I'd already invested in real estate. Ultimately, I wanted to be the investor. I didn't realize I was kind of the go-between between, the seller and the investor. Not what I wanted to do. So joined Future Flipper because, like I said, I kept tabs on what Ryan was doing. We'd talk every now and then, and so joined Future Flipper to get into flipping houses. Within a month, I had my first property to flip, and very quickly realized that I also didn't want to flip houses. Just was not in my nature. I'd lost all kinds of sleep over it, and we're talking a $320,000 house. Was not what I wanted to be involved in. So during that time, I stayed in the group. I stayed active in Future Flipper. That's how Alex and I really met, was in that group, and started doing more research into, okay, what's this multifamily thing? I've done the single family thing. Always kind of had the thought of, I want to move my single family into multifamily, exchange into it, go from 1 unit to 2 to 4 to 8, and kind of follow that progression. What I didn't understand was how these multifamily deals are actually structured. A lot of times they're partnerships. You have a general partner who operates the deal, puts everything together. You have a limited partner that puts in all the money, but isn't responsible for any of the day-to-day. Once I found that, I was like, oh my God, I wish I'd known about this 5 years ago, because I would have been doing that while I was playing as an LP, right? Because now I'm not responsible for any of the getting the loans, taking phone calls, maintenance, any sort of that stuff. And then I realized, well, now I have all kinds of time on my hand. I can be a GP as well. I can run these deals and, raise money from people who don't want to be active. I do want to be active, but I know from experience, I did not want to be active back then. So that's kind of the 1,000-foot view of what, the progression, how I got to where I am today.
I'd like to just kind of dive a little bit on the front end here too, of like your acquisitions. Like when did you get your first deal? How many doors? I know you have a deal right now that you're working on, you can't talk about, no problem there, but walk us through your deal flow over the last year and a half, because I had the curious question with you, like, hey, how much did that one first deal kind of add to your net worth and or your the bottom line, so then I could have more context in the future on me analyzing deals. But yeah, can you walk us through like your deals and what you've worked on?
Yeah, so like I said, I don't know if I mentioned this, but I hired a mentor back in about, let's see, it would have been October, November 2020, and started learning the underwriting process, how to structure these deals, how to get in touch with brokers, all the fundamental stuff you have to know to be active. So started that in about October of 2020. And by January 2021, we had our first deal under contract, which was 46 units. And that was an $8 million deal. Now, one of the things I'm sure we'll touch on here later is, at first, before I brought someone in who knew how to structure this stuff, I was looking at 10 units because I could wrap my head around it. And I was looking at what I could do by myself. Now, when I had someone who's, by the way, this guy, his name's Robert Beardsley. He has over 2,000 units now, and he's 25 years old. So clearly this is someone who knows how to scale a multifamily business and how to put these things together. So having that person in my corner to look over my shoulder and, hold my hand essentially in certain areas was what allowed me to go to 46 units on the first deal. So like I said, that was an $8 million deal. Now, to answer your question, how has that impacted me personally? Just being, in the context of like the grand scheme of things, I probably own 25 to 30% of that deal. But you look at what's happened over the last 9 months in Phoenix, that has probably added, just that deal by itself, I'd say close to $2 million to my net worth, just because of one deal. And here's the thing. That's if that's just 10 units, right? Obviously that's good too. but the number of units is the key thing, because you make little incremental changes on one unit and you spread that out across, 100 units. That's a big number. If you increase the rents $100 on a fourplex, okay, that's great. You got an extra $400. If you do that on 50 units, that turns into a big number very quickly. So that's why that's happened. And then, you add in a second deal with the appreciation of the market. Like, I didn't know that. I had my theories that would happen. I didn't know it was going to happen, but that's what's happened. So, yeah.
Yeah, no, good. I mean, I know the reason we also want to bring you on, because even though you do have experience, you've worked on a couple of, you've worked on some rentals, you were a professional baseball player, so you were making some money at some point. But it's that transition isn't easy. And I'm glad you actually got a mentor. I don't think we talked about it, but it's funny. You recommended his book and I picked it up. And so like, I've been diving real deep on it. Amazing, good, concise, great read so far. And it just talks so much about the, the partnership structures, the underwriting of these files, like how to really look at the numbers. And but I think a big part of what we brought you in, because it's like you got the one multifamily, now you're working on a couple, and you're starting to really kind of, people are more relate more to someone like yourself than somebody that already owns, like you said, 2,000 units or
Right.
huge portfolio of 500. I know one of my mentors or one of our lenders that's helping with this 18 unit. I mean, he owns over 1,000 units himself. So those were different conversations, but I mean, you got to start somewhere, and it's better you start off on a higher door count if you can. But believing that you can do it from the very beginning is kind of hard if you don't have the right people behind you, supporting you.
Yeah, exactly. And there were instances where I was a little nervous. We're talking, I mean, shit, I've never taken a $6.7 million loan out before. I don't know how this is going to play out. And it's been nice to contrast that with like each subsequent deal has essentially gotten a little bit easier, because I know the full, list of things that needs to get done. I know what the whole process looks like. Whereas the first time I did it, I don't know what's coming. I don't even know what the next step is. I'm just focused on getting the current step done right now. So now we can be a little more strategic, and I've brought on a partner since then. So I know what to hand off to him so he can learn the process, something that he can handle. Obviously, I'm still overseeing everything, but I look back on it now and I don't understand how I was able to do so much of that just by myself. But again, I wasn't really doing it by myself. Rob, my partner, coordinated all the debt. I didn't have to do anything with the loan. Another partner of mine, Gordon, he helped to raise capital. So one of the points here is, again, if you're looking at what you can do by yourself, you're automatically limiting yourself to what's actually possible. When you start bringing in partners who have different strengths, you start expanding the size of what you can do in your first deal. And like I said, yeah, being able to do a 10-unit deal or whatever it was as the first one would have been awesome. Some people never do any deal at all. But, raising $2 million was pushing me outside of my comfort zone for sure. But it wasn't like I was going to $10 million from trying to raise $10 million. There are, what's reasonable and also what's getting you outside of your comfort zone.
But that first deal, Christian, you didn't actually have a team, did you yet? It was just kind of you, and then you had obviously some rentals and some resources and whatnot, but you didn't have a team yet.
No, and what I realized was, like I said, I got under contract in January, and it was me and my partner Rob who was really mentoring me. And I quickly realized I need more help. There's a lot to do here. I don't know if I can, raise this capital. I got to focus on just keeping the deal together, doing due diligence and all that stuff. It's a lot of work. And another point I want to bring up on why to go as big as you can on the first one, it's just as much work to buy 15, 18 units like you're buying right now as it is to buy 46. It's the same amount of work. So I would rather buy something bigger, right? Because, those economies of scale, things actually get easier the bigger you get, because the property is bringing in more revenue. You can have more help. You can have more professional management. Whereas, another thing, if you're buying 5 units, you're tempted to manage that yourself. And that's not a way to scale. You guys know that better than anyone.
And is it also safe to say, and this might be advanced, but it's safe to say that once you acquire the first one and it performs well and it did hit the numbers you expected or better, it helps you get financing, attractive financing for the follow-up acquisitions?
Not so much on the financing side. The financing, what makes it easier on bigger buildings is that the bank sees it as safer. And just look at the interest rates, right? If you were to bring a 10 unit property to a lender, and then you were to bring them a 100 unit property, I absolutely guarantee you that the 100 unit property would have better terms, better rate, more interest only, more leverage, all kinds of things. Because they look at the 10 unit one, and if 4 people move out, which is not that big a number, you may be struggling to make your payment.
Yeah.
And that's exactly how the lender sees it. But to answer your question, yeah, after doing the first deal, the second deal becomes much easier because, again, you kind of know the process. And then as far as how brokers see you, you've closed a deal, you've closed a multifamily deal before, and that experience and credibility makes that second deal much easier.
Yeah.
Good stuff. One thing I just wanted to kind of highlight on as well, because I know there's a lot of people that call it, like the shiny object syndrome, right? But like for you, Christian, you went from doing the one rental at a time, which there's a lot of respectable investors out there that have 9-to-5 jobs, right? That just, that's what they can, personally take on year in and year out. Hey, one rental, one rental, one rental. And then you did a flip, and you saw a little bit of less success there. And so I just think it's commendable again that, you were able to kind of identify what it was that your strengths were and what your weaknesses were, and really kind of focus in on like, hey, this is where I can really focus in. I can raise this capital if I get somebody else to help with the due diligence side of things. I can do these other things, and I can, attest to that, because Alex and I, we talked about that too. Like, we want to find ourselves in those uncomfortable situations, right? If you're in that uncomfortable situation, it usually means there's something big on the other side.
Yeah, for sure.
Yeah. And, to me, it's like, and this is kind of how baseball and sports in general are, like, nobody has ever had an entire career that's all success, one after the other. Even the Tom Brady's and, ultra successful athletes, they have their set of failures, but it's really how you respond to those failures. And so I used each one of those experiences, absolutely failing at flipping a house, and learning from that experience, but also knowing, like you said, what am I good at and what do I want to be good at? Because, yeah, could I put the work in and build a successful flipping business? I think I could. It would feel like work, and it would, to me, this is just me personally, it's nothing against flipping houses. To me personally, it did not jive with what I wanted to do, and I could feel that deep down. So I had to keep looking and not get discouraged by the fact that, yeah, I screwed this up. But at the end of the day, I just need to keep looking. I'll figure it out eventually. And think about how silly that sounds. I was losing sleep over a $320,000 house, but I've since taken out $14 million in loans and raised millions of dollars. To other people, that may sound like that doesn't make any sense, but I swear by it. I lost way less sleep, if any at all, over those multifamily deals, because I could feel that, yes, this is what I want to do. This thing I'm dealing with right now is difficult, but I know the reward is there. I'm in tune with what I'm doing. I didn't get that feeling with flipping houses.
Yeah, I mean, I think you have to pay attention to what fires you up, and for us too, like, we like the big deals, so that's why we're getting into this space. And we're like, I see the potential on it. I mean, I think that fires me up more now than like flipping a house, in the desert, another house in the desert. I still love it. I love it all, but working on a bigger deal is more exciting. What is what does your kind of team look like now, or kind of what do you what's kind of current, like, I guess on the docket? What are you mainly working on currently?
Yeah, right now, as far as my current team, and it's really hard to say, to exclude property managers and stuff like that, accountants, like, technically we have a pretty, substantial team. But as far as in my company, it's me and my partner, Jeff, who we've been best friends since high school. And he recently moved out here from California. And so he's obviously someone I trust, probably more than anyone. And so I'm teaching him kind of the business, and like, he's never worked in real estate before, but he has a lot of experience in project management. He worked for the city, one of the cities in Los Angeles, and that's stuff that I am not good at. I don't want to be good at. So to have his help, and he's very good at it and likes doing it. So to be able to offload stuff to him and teach him along the way, okay, here's the process, here's what we need to do, has been huge. But outside of that, we have accountants, we have property managers, we have people beneath the property manager who handles day-to-day stuff, attorneys. I'm sure I'm forgetting people. Oh, obviously our general partners who are involved in the kind of the management of the deal itself. Like I said, my partner Rob Gordon,
I'm
who's
sure you have
helped with
a
raising
slew
capital.
of inspectors on inspectors. I'm sure when we go out, we do a lot of inspection.
Right.
So I would assume that you probably have a good list of inspectors out there that you're working with on a regular basis as well, contractors, vendors, things like that too, right?
Yeah, and anytime I'm evaluating a new deal, I'm going to our property manager and I'm saying, hey, what do you think of this deal? Can I get some market rents? What do you think we could do with this property? So, like I said, my internal team is just me and my partner. A lot of stuff that goes into acquiring and managing larger assets. A lot of that is, separated out. I'm sure as hell not collecting rent or, managing evictions or any of the nitty gritty stuff. I get reports at the end of the week and we talk about strategy with our property manager, what needs to get done. But again, if the smaller the property, I feel like the more tempted you are to try and do all those things yourself. Like I said, you're going to be limiting how much you can actually grow if that's the case.
Yeah.
I again, I think it's incredible when you kind of break down some of the numbers and where you've gotten to and where you've gone from. I think there's about 30 people here in the room. Would just love to open it up, guys. If you guys have any questions, again, I know this is, a topic that typically we do not normally cover. So we have a couple things that we'll kind of continue to dive into from Christian's story. But if anybody does have questions in the meantime, this is a guy that's, really kind of transformed his real estate investing strategy into now taking on $14 million worth of loans. So again, it's kind of, phenomenal when you think of that in a couple of years. So if you guys have any questions, feel free to use the Q&A feature down there and we'd love to jump into those. Go ahead, Alex.
So hopefully we have some questions. I think we should also definitely discuss, sourcing properties, acquisitions, how you underwrite deals. I know we only have an hour, but I think these are some of the topics that we could provide a lot of value. I think we've had a lot of conversations about, hey, how do you get these deals? Why are they different than single family? And also, what are a quick way to analyze a deal, perhaps, and or kind of a financing kind of partnership structure. I think those are all topics that people want to ask, but we'll see what the attendees want. But for myself, I think those are things that I find as a common, I guess, roadblocks as a new investor. Like, okay, well, how do I get these deals? Or well, how do I structure them? How do I review them and analyze them? I think it's much easier to like review a flip deal. Right? You buy the house for this price, you fix it up this price, and then you sell this price. Not the same in multifamily.
Yeah, I don't know if you guys can see the chat here, but there is one question that's how do you find a multifamily deal? So that's probably the most common question I get. And I have taken the approach of going strictly through brokers. And can you market and cold call owners and stuff like that? Yes, you can. And perhaps there's some deals out there to be found that way. Obviously, I'm in Phoenix. So very competitive market. And just the way a multifamily brokerage kind of works is, there's many guys in the office and they all kind of have specialties. Usually there's a team that does, 2 to 30 unit properties. And there's a team that does, and sometimes it's done by dollar amount, but 30 unit properties to 100 unit properties. And then there's the 100 unit plus team. So first of all, the first thing you have to be able to answer is what type of property are you looking for? What size? What area? what class of building? Is it stabilized? Is it an absolute mess? Like, you need to be able to put that down on a piece of paper, because what you're going to do is you're going to find the brokers in your market who are the most active. There's usually 5 to 10 that do most of the transaction volume. And the strategy I took, I found the lowest guy on the totem pole, right? He's one of the associate brokers. He's just getting started in the business. Our incentives are aligned, right? We both want to build our business up. He wants to get higher up into those bigger properties, and so do I. So if I'm a new person and I try to go to the top guy, the 100-unit guy, he's not going to take my phone call, right? Let's be real here. It's just not going to happen, because you have no credibility. And say what you will about that, but that's the way it is. So first of all, be very clear on what you're looking for. Get in touch with that broker. Tell them what you're looking for. And at first they may not respond. Keep following up with them. Keep following up, and they're going to start to take you a little more seriously. When they send you something, the best thing you can do is, whether you like it or hate it, tell them. Either way, I absolutely hate this. This is not what I'm looking. Maybe it's a little nicer than that, but say, no, this is not what I'm looking for. Give them feedback immediately, because if they send you something and you don't say anything, then they're like, okay, well, this person's not really serious. They're not going to continue to spend time on you. So give them feedback for every deal they send you. And a lot of people look on LoopNet. That's more a place to find brokers than deals. Most of the deals on there are either already sold or they're not very good to begin with. But what you can look at is who is listing those deals, because and that's where you can make your list. Okay, here's 5 brokerages that I want to get in touch with. Go directly to their website, get on their email list, and you'll start to get properties that are on market at first, and evaluate those deals. Get some knowledge of what's going on in the market. And then if those guys start to send you deals directly that may not be on the market yet, that's when you're starting to get your deal flow up.
Good stuff. And I know you mentioned a couple terms there. I just want you to break those down for us. You mentioned classes of buildings. So, for some of the newer investors on the call, in multifamily, you have different classes of building. Can you just give us a brief kind of rundown on what those are and why that might affect your investment strategy?
Yeah, so Class A is going to be something that was built in the last 10, 15 years. So right now, well, maybe a little sooner than that. So maybe 20 years would be Class A. Anything, 1980 to 2000 is probably Class B. Anything below 1980 is probably Class C. And then there's kind of the area it's in. You can do the same thing with areas. So I know Arizona, so I think a lot of people are pretty familiar with it, but Scottsdale, Class A area, obviously. Class B area, lots of parts of Mesa and, parts of Phoenix. Class C is going to be, kind of maybe around the airport, South Mountain, up and down the 17. Those are Class C areas.
So you can have both classes of the building, building quality and building structure, and then also, the neighborhood class. And so those do both,
Exactly.
Affect people, and appreciate you kind of breaking that down, because, again, I know some people on here are a little bit newer to the call. So let's go ahead and go over another term that comes up pretty often. Ulysses here has a great question asking about, what your thoughts are on an LOI. What is an LOI? Do you recommend using it, and where does that come into place, right?
Yeah. So yes, you always use an LOI, and a little bit, it's kind of an extra step in the process as opposed to single family. So LOI is a letter of intent. And anytime there's a property that's on the market, or even if it's off market, the first step you're going to take is you're going to send a simple 1-2 page letter of intent saying, here's what I want to purchase the property for. Here's the price. Here's how much earnest money we're willing to put down. Price and terms is basically what you're spelling out in the LOI. Because there really isn't a standard commercial contract that gets used like a realtor contract. It's a little more complex because you're dealing with a larger asset. So you don't want to go to all the trouble of necessarily sending a contract, and because it takes a lot of time to do that. You're having attorneys draft those. So the first step is to send a letter of intent, and it's non-binding, but you're basically stating your intentions to the seller. If they're interested in entertaining that offer, a lot of times they'll send back a red line counter on that LOI where they say, okay, you sent your price in at 5 million or whatever it is. We're going to counter back at 6, counter back these terms, we'll get a red line one. And then sometimes they'll sign that. So then if you're okay with those terms, you sign it. Okay, now we're under agreement. We're not under contract, right? Because we have contract yet. Letter of intent is non-binding. We're under agreement. We've kind of agreed to terms. Now we're going to start going through the process of putting together a purchase contract. Then once that is signed, then you're under contract. So yeah, to answer the question, always use LOIs.
Yeah, and I think Lindsay in the chat brings up a great point, which you just kind of answered exactly the same, right? Which is, how do you simultaneously reach out to this broker, make an offer without having the money yet? How do you establish that confidence and credibility? Well, it's by making that LOI, right? By making that letter of intent, you're showing that broker, hey, I know the policies, I know the procedures, I know how to play baseball, I know how to come up to bat, right? I know, what I'm doing in the batter's box here. And so I think that's a great way of looking at that, right? And that LOI really breaks that down. It's your agreement before you're actually signing a contract. So I really love how you broke that down.
There's kind of two questions there as far as credibility and letter of intent. So a letter of intent is just the first step in the process. But even if you send a letter of intent to the broker, they're going to start to vet your credibility. And I've been in many of those conversations because if they don't know who you are, they're not necessarily going to take a non-vetted letter of intent to the seller because, they don't want to waste the seller's time either. So there's probably going to be some follow-up questions there. And one of the immediate credibility checks you might get is, let me see proof of funds. And that is a rookie screening. That's what that is. Because if you're syndicating the deal, you don't have proof of funds. You don't have the money. So when you get faced with that question, if you back down and go, oh, I don't have the money, they're kind of filtering you out right there. But if you just come out and say, look, we don't have proof of funds, we're syndicating the deal, we're going to raise the money before closing, and you're confident and you're able to carry on that conversation and not necessarily deflect the question, but answer and say, look, we don't have it. What do you want me to do? We're syndicators. So, and then just kind of establish credibility in some other way.
Yeah.
I love how you broke that down, right? Because it's two pieces, right? Your intent and your credibility, both two pieces right there. And Alex, these are things that we're dealing with as well on our first deal of 18 units, right? Is how do we establish our credibility when you're purchasing, when you have these, loan requirements from your brokers and things like that. So I love how you were able to break that down. That's good stuff. And Ulysses in the chat is giving you some fire emojis. He appreciates you answering that question that he had. That was a great answer, man. Let's dive into another question on here. And I think this bodes well as well, because, Alex, we know in the single family market, it's obviously ultra competitive out here in Los Angeles, Christian in Phoenix, one of the arguably the most, fastest growing markets out there as well. What do you think about multifamily being a little bit less competitive of a marketplace comparatively to single family?
And let me just clarify, less competitive meaning easier to get properties?
Yeah, I mean, I think maybe easier to get properties or less people in the space, maybe. I know for us out here in Los Angeles, there's a lot of players in the space and same within, Phoenix. So maybe both ends of that question.
Yeah, so that's one of the things that I do like about, larger scale multifamily is, yes, there is less competition in the sense that you're not competing with someone who just wants to buy a house. You're dealing with professional investors who are buying this for one reason and one reason only. So in that sense, yes, it is less competitive. However, that does not mean that it's easy, because now you're starting to deal with some very large players, possibly the bigger the assets you're getting into. So in the end, I think it's just as competitive, maybe even more competitive. I don't really know how to measure that, but it's certainly competitive. And just because there is a higher barrier to entry doesn't mean it's any easier, I would say. Because like you
Yeah.
said, we're in a very hot market.
Yeah, I would agree, Christian. I don't think it's easier in any way. I think it's competitive in a different way than single family is. But it's just as much of a shark fight. I mean,
Yeah,
either way. So it just depends on, you know. But if you're going to be in a shark fight, if you're going to be in something, you know, that it's going to be very competitive. Why not try with play with the bigger dollars? You know, with the
exactly.
you know, so cool. Do we have any other questions that we need to answer?
Yeah. Oh yeah, we got a couple killer questions coming in from Edward, and then we'll go ahead and get a couple of guests on screen and share everybody and end things out. But Edward, just to preface things, you know, again, Christian is out in the Phoenix marketplace, which is where he's pursuing most of his deals. So they have a little bit, you know, different kind of tenant laws out there. But his question is wondering on properties that have current tenants below market rents. How are you dealing with that? And is that what you're doing most of the time when you're doing these value adds? Are you doing more of rehab or more, you know, rental income ads? And if you don't mind, could you break down what the value add term means as well? Just again, I know that's a term that a lot of other folks on the call might not be familiar with.
Yeah, value add is a term that in the space gets thrown around. Pretty much every deal you look at is a value add deal. There's some sort of value add component to it. That can be, like you said, through rehab. You could go in and renovate units, or it could just be by bringing rents to market. So yeah, it is obviously bringing rents to market is where you're really going to add actual value to the building. Because for people who aren't familiar, a multifamily building's value is derived from the amount of income that it brings in. So you have your income coming in from rent minus your expenses before any debt considerations. That NOI, net operating income, is applied to a cap rate, which I see Edward just put in here. And that's where you get your value from. So really, when you think about it, the value add is not necessarily in putting rehab actual dollars into the property. It could be a piece of it, but really what you're doing, the reason you're doing that is so that you can bring the rents up a certain level, because that's what actually adds the value. But conceivably, you could spend absolutely $0, bring the rents to market, and yes, you've just added value to the building.
Great breakdown, man. That was literally, you know, mic drop right there. I think, you know, for everybody that doesn't know what the cap rate is and again what the value add is, I think that really kind of broke it down. So thanks for kind of doing that there. You know, Lindsay has another great question, you know, kind of answering a little bit more about the structure of your deals and how you kind of bring in partners. I know you mentioned earlier the GP versus the LP, and you know, we've kind of talked a little bit about syndication and how you're able to kind of raise these funds. If you could just break down a little bit more on the partnership there, and then Alex, if you go ahead and make me host, we'll go ahead and get some of the other folks on here, and everybody can kind of share screen and you know, we'll end here in the next little bit. And again, appreciate your time, Christian, because this has been you know, gem after gem after gem that you've been going over here for us.
Yeah, absolutely. Having a blast doing it. So as far as the structure, I'll try and stay out of the weeds here because it can get a little complicated, and you know, it's something that is almost better seen visual. But the easiest way to explain it is you have the general partners who are operating the deal, and generally the equity is split in some sense. So the limited partners are bringing in money, and they own anywhere from, you know, 60, 70, 80% of the deal, and the general partners own the other percentage. And it's essentially structured so that the general partnership has to do something, has to perform and add value to the building, like we talked about. They have to optimize the investment before they get paid. And so a term you might see or hear is a preferred return. So simple example is, let's say we buy a building and there is 7% cash flow going in. and let's say we have a 7% preferred return on this property. That preferred return means that 100% of that cash flow, up to 7%, is going to the investors. So it wouldn't really make sense if I were to buy the building with, all these investors coming in, and I didn't have to do anything. And all of a sudden I'm participating in, the economics of the deal, because I didn't put the money in, the investors did. So I need to do something to optimize the property. So what would make sense is if you have 7% cash flow going in and a 7% preferred return, all that money is going to the investors. But if I raise the cash on cash return to 10% on that property, now on that spread of from 7 to 10%, we split that 70% to the investors, 30% to me, or to the general partnership. And again, the general partnership can be made up of a few different people, but that's kind of the basic structure. I hope that kind of helps. I don't want to go too far into IRRs or anything like that.
Yeah, and obviously things can change on a deal by deal basis, but I think that's a great general kind of breakdown on what your GP role and what your LP role are going to look like in a multifamily partnership, right? So again, I think this was just a wealth of knowledge here. Alex, do you have any kind of final questions that you kind of want to selfishly squeeze in here for Christian while we have some of his time?
Well, my main thing was, Christian, thank you for your time and for blessing us with so much solid knowledge and also helping us on our 18 unit. How can we help you? What are challenges maybe you got going on anyway that our tribe can help you out?
Well, I mean, always raising money, always wanting to get people to get invested in our deals. So of course, if anybody has any interest, please feel free to reach out to me or reach out to Camacho or to Alex.
What's the best rate that our tribe members and deal makers can reach out to you and get in touch with you if they have any other questions or wanted to invest into a deal?
Yeah, a couple of ways. I'm on Instagram, cbergman36. You guys can, I'm sure, put that in there.
Well, we'll put that in the chat.
Yeah, and then our website, our company website is mulliganvalleycapital.com. I've got a bunch of resources on there, articles that kind of explain structures and stuff like that. And we have a contact page. And I would also recommend signing up for our newsletter. I do a monthly newsletter where we go through just kind of overview of what we're doing as a company, what's going on in the Phoenix market in multifamily. And then I cover some sort of general topic, current event as it relates to multifamily. So it can be a good resource for everyone as well.
Awesome. That's all I got. I took a lot of notes. I'm reading that book. I'm halfway through. I think I'm gonna have to read it a couple times, and then we'll be down.
It's a deep dive.
Yeah, we'll be down there for the 18 unit closing at the end of the month. So I'm sure we'll be hanging. So anybody have any last questions or anything else they want to talk to Chris about, Mr. Christian?
I just want to say, Alex, thank you for bringing this. Chris, thank you very much for your knowledge. And that's because when I started learning about real estate, the first thing that I was interested was commercial. So this really brought a lot of emotions in me, and I was just super excited, man. Thank you. I appreciate it.
Man, glad I could help. Hope I answer your questions, and feel free to reach out if you need anything else.
Cool stuff, man. And I know, again, for a lot of people, you get kind of into one, train of thought, one method of real estate investing, but there's hundreds of ways to get into real estate investing. Christian's tried a couple until he found what he was really passionate about. I know, Alex has been really passionate about flipping and has now kind of found a new passion in multifamily as well. So, don't think that because you failed at one thing, that was your only route into real estate. You might just need to try a little bit differently. You might need to do what Christian and Alex and I have done in the past, which is bring in other mentors and people that we trust in the business. So again, like Ulysses said, like Alex said, we thank you for your time, Christian. The guidance and everything you provided today was amazing. And hopefully, guys, if you didn't learn enough today, you can follow Christian. He drops a lot of information on his podcast, on his Instagram as well. And so make sure you follow him. I did drop his Instagram in the chat. So that you guys can all follow him here today as well. All right.
I appreciate it, guys. I had a blast here. Happy to do it again sometime.
All right, guys.
Cool stuff, man.
Let's get some deals. See ya.
Let's go.